So we'll go to the section on real options within derivatives. I think question number 47, 48, 49. These are 3 new questions that have been added along with some theory which has been added within the chapter on derivatives, but that is within the theory section. We'll just review that once separately, but more importantly from the numerical side in derivatives, there has been abandonment options, growth options and a few other options that have been added over here. So when we are looking at, let us say real options, what does real options mean? It means options on a capital budgeting project, not necessarily options on a financial instrument like call, put, etc. These are financial options. So broadly, real options also function in the same way as financials do, but financial options have data which is much more easily and reliably available. There are quoted market prices, etc., which are not there in case of a real option. Further, the financial options are usually for a relatively shorter period, whereas real options are for relatively longer period. A capital budgeting project is longer period. These options are relatively for a much more shorter period. So what do you understand by abandonment option? Abandonment option is like a long put option where we have a right to sell. So if we have a right to sell, this is called as a put option. We have bought the right to sell. So that is called as let us say an abandonment option. Now, how will you value these options? Well, in general, you will use almost the same principles that you use even for financial options, like in Black-Scholes model or binomial model. Depending on the data available, you can value. So we'll understand this with the help of sums only. So we'll go to question number 48. Go to question number 48, page number 744. You can focus in your screens if you don't have volume 2 handy. So question 48, IPL Limited, please pay attention. So a tricky question, sir. IPL Limited is already in the production of fertilizers, is considering a proposal of building a new plant to reduce pesticides. Okay. Suppose the present value of the proposal is 100 crores without the abandonment option. So this is the present value given to you. However, if market conditions for pesticide turns out to be favorable, the present value of the proposal shall increase by 30%. On the other hand, if the market conditions remain sluggish, the present value of the proposal shall be reduced by 40%. Achha, what is the current present value? 100 crores. The question says that if the market conditions turn out to be favorable, then the present value will increase by 30%. So instead of 100, it will become what? 130. On the other hand, if the market conditions turn out to be sluggish, then the PV of the proposal shall be reduced by 40%, which means instead of 100, it will become what? 60. So how many outcomes are there? 2. Achha, if generally in option valuation there are 2 possible outcomes, up move, down move, what method do we generally follow? Binomial. In this case, in case the company is not interested in continuation of the project, it can dispose it off for 80 crores. Achha, an option to dispose of for 80 crores is similar to what? A put option, that is an abandonment option. You can abandon it. Now, these are general questions which are given by the institute. We have kind of taken that. Ideally, they should have mentioned that this option to abandon is after how many years? That has not been mentioned. So if nothing is mentioned, even in this question 48, even in the next question they have not mentioned, but they have solved considering that this option is available after 1 year. So if nothing is mentioned, you will assume that these options are available after 1 year. If the risk-free rate of interest is 8%, what is the value of this abandonment option? So if I were to look at the value of the abandonment option, now there are 2 possibilities. So if I look at question number 48, the present value today is around 100 crores. Like we say spot price today. Remember in binomial option we say spot price today. But that spot price can possibly go up. That spot price can possibly go down. Actually, if the spot price possibly goes up, after how much period we don't know. Let us say after 1 year. If the spot price goes up after 1 year, we are saying that the value would become how much? The present value will become how much? 130, that is 100 plus 30%. But if it goes down, then the value will become how much? 60. It is like spot price. We treat this present value like S0. This is let us say S1. This is let us say S2. Now we are trying to find the value of the put option. How do you do that? Well, we find the option payoff. Tell me, if I have an option to dispose of, my exercise price will be 80 crores. I have an option to dispose of at 80 crores. So if I have an option to dispose of, for example, at 80 crores, will I exercise that option? At year 1, when the price is 130, will I exercise it? No. Why will I demand 80 when I am getting 130? And hence this will not be exercised. Are we getting this? It will not be it will not be exercised. Are we getting this? So my put option payoff is 0. However, if the price is 60, will I prefer to exit and get 80 rupees? Which means what will be the value of the option at P2? How did you get 20? 80 minus 60, and that is about it. So these are the two nodes. Now tell me, there were 2 or 3 methods that we used in binomial. What was the easiest method that we typically use? Risk neutral probability. What was there in the risk neutral probability? You assume the probability of an up move to be P, down move to be 1 minus P. Now, how did you do that? Well, we said the price today is the present value of future cash flows. Acha, are you given the rate? How much is that? 8%. Acha, you have not been given the time, but we have assumed the time to be how much period? 1 year. If the time period was given, we would have taken that accordingly. But let us say if nothing is given, we can assume it as 1 year. So if I want to find the probability, I can say that the value today, that is 100, equals to the present value of future cash flows. That is 130p plus 60 into 1 minus p, the entire term divided by 1 plus 0.08. Therefore 100 into 1.08, that is 108. This is 130p plus 60 minus 60p. Therefore you will have what? 48 equals 70p. Therefore p equals what? 0.68. So 1 minus p will equal what? This is 0.6857. 1 minus p will equal what? 3143. So this is 0.3143. Chalo, question done. How will you find the value of put option? Probability based weighted average. We are saying that there are two possibilities. The put option can give me a 0 value. Abandonment option can be worthless. Or the abandonment option can give me a 20 value. The possibilities of each of these events happening are both of these. And as a result, if I were to find the value of the put option, the value of a put option will be 0 into 0.6857. 0 into 0.6857 plus what? 20 into 0.3143. And as a result, if I divide this, this will be 1 plus what? 0.08. So this will be what? 20 into 0.3143 divided by 1.08. This is what? 20 upon 1.08 comes to what? 5.82. And can I say this is the value of the put option? In today's terms, this is 5.82. So if you do this entire working, there are a couple of reference notes given. This is 5.81 or 82. As a case, maybe that is the value of the option. Straightforward. सुनने में difficult लगता है, it is not as difficult. Yes, okay. Next we'll go to question number 49. Question number 49. Now suppose MIS Limited is considering the installation of solar electricity generating plant for the lighting of the staff quarters. The plant shall cost 2.5 crores and shall lead to saving in electricity expenses at the current tariff by 21 lakh per annum forever. अच्छा, so if I install solar electricity plant, अच्छा क्या वो मुफ्त में install होगा? No, I'll have to spend 2.5 crores. But in return, am I getting some benefit? Yes. How much am I getting? 21 lakh per annum forever. So is this project viable as of today? Well, we'll have to see the discount factor. However, with the change in government in the state, the rate of electricity is subjected to change. As you would be aware, let us say there is certain government in Delhi who might say power is free. Certain government might say कि चलो power का cost increase करे. अरे बराबर क्या नहीं? So if I am putting such an expensive solar plant and the government, like the Delhi government said that for most people power is free, then what is the point of spending 2.5 crores? I might as well buy the state power which is free of cost. But if the government is such that it is increasing power cost, then it is making sense. There's a change. There's a change in the government. It is subjected to change. Accordingly, the saving in electricity can either be 12 lakh or 35 lakh per annum forever. As per the current government, it is 21 lakh. But if the government is likely to change, the saving can be just 12 lakhs or the saving can be 35 lakhs. Assume WACC of MIS is 10% and the risk-free rate of interest is 8%. So there are two rates given. One is the WACC given and one is the risk-free rate given. For NPV evaluation, do you take the risk-free rate or do you take the WACC? WACC, that is the risk of the project, and hence you should be taking WACC. Perfect. Decide whether MIS should accept the project or wait and see. So here no one is giving you any option. There's no abandonment option here. But here it is like a timing option. What do you mean by timing? That should I go ahead and invest in the project today or should I wait for the elections which are just around the corner? Should I wait for the elections, see the government, and based on the government take a decision then? That is what I'm trying to see. So let us say if I look at the current setup in question 49, what is my PVCO? On my current setup it is in crores, 2.5 crores. So in lakhs it is 250 lakhs. In return, I will try to find PVCI. As per the current setup, 21 lakhs. 21 lakhs divided by what? 10% or 8%? 10%. Acha, we will have to apply the Gordon's formula. Acha, when you look at, just a second, when you look at, let us say the Gordon's formula, under Gordon's formula, this is D1 by KE minus G. Acha, that D1 can be replaced by any factor. It is not necessary that the D1 has to be dividend only. It can be any number that goes on till perpetuity. In this case, the number that goes on till perpetuity is what? 21. Acha, is that 21 growing? No, there is no growth rate given, and as a result, 21 continues to remain the same. Acha, what is the discount factor? So if I do 21 divided by 0.1, my answer comes to what? If I do 21 divided by 0.1, my answer comes to what? 210. But if I want to get savings worth 210, I'll have to spend how much in today's terms? 250. Is it worth spending that? Why no? The NPV turns to be negative. So just a second. So over here, if I look at 21 divided by, for example, 0.1, this comes to, let us say, 210, and at 210, my NPV, so over here, just a second, my NPV would be a negative NPV of negative 40. So one thing is very clear, that it is not advisable to invest in the plant today. But timing option, well, we are saying that there are two possibilities. Today the NPV आपका negative 40 आ रहा. Today your present value of cash inflows is coming to be 210. अच्छा, are we told when will there be a change in the government regulations? No. Again, institute has assumed 1 year over here. It can also be 2 years, 6 months, 3 months. Like question 48, they have not given you the time frame. Ideally, they should give the time frame. Let us say they are saying after 1 year, the government is likely to change. And if the government changes, possibly there are two possible outcomes. Acha, the possible outcomes will be, there will be a saving of 35. Again, the discount factor is, 10. And as a result, this will be 350. This will be my PVCI. Acha, what will be my PVCO? Still, I have to spend 250. And as a result, what is my NPV? Now, does it make sense? Acha, second, there is a possibility that the saving will only be 12 lakhs. 12 divided by 0.1, this will be 120. Compare that with the PVCO, still of 250. And hence this comes to what? Negative 130. Now does it make sense? But do you know the probabilities of these events happening? Can we find what we call as a risk neutral probability? So what do? I will again make that binomial tree where I will say that there are two possibilities, up move or down move. अच्छा, यहाँ पे अपन अभी क्या करेंगे? It is like saying that one is the value of the option and one is the value of the share. Remember, probabilities we find first based on the value of the share. And once we find the probabilities, we use that for the purpose of option and for the decision making. So over here, what is the PVCI? It is like value of share, spot price. What is my PVCI? This is like S0. This is 210. This 210 PVCI at S1 can possibly go up. अच्छा, ये एक problem होता है. We have said real options, we don't have the spot prices, so we'll have to assume spot prices. So we are saying it is like a share whose value today is 210. अच्छा, how do you value a share? Sir, share is valued as a present value of future cash flows. In a similar way, the value of this asset is 21 rupees up to perpetuity. Yes, मेरे को खर्चा 250 करना पड़ेगा. But I'm saying, what is the value? The value of this asset is, for example, 210 rupees. Are yes or no? That 210 can possibly go up to what value? 350. Or it can possibly go down, S2, to what value? 120. Are we getting this? Acha, if it indeed goes up to 350, your NPV will become how much? 100. But if it goes down indeed, think and tell me, to 120, your NPV will become how much? Negative 130. Here it will be negative 130. There is no one who is giving you an option here. Okay, if you want, you continue. If you want, you abandon. ऐसा कोई option नहीं आपके पास. Are we getting this? And as a result, these are the two possibilities. NPV can very well become negative 130 as well. Achha, what is the probability of an up move? P. Down move? 1 minus P. Therefore, if I go to C, अच्छा यहाँ पे और एक तकलीफ आएगा. Here, this is the thing that has never been tested for you. So over here, let's say you have exercise, price, etc. Time we are assuming to be 1 year. अच्छा, now hold on, okay? Think and tell me, for the purpose of binomial valuation, what is the rate you should take? There are two rates, 10% and 8%. Till now we have taken 10% everywhere. This is now option valuation. Binomial ke liye we take which rate? Why? Why do we take the risk-free rate? Because you build up what is called as a risk-neutral hedge, risk-neutral probability, a replicating portfolio where there is no uncertainty. The payoff of the call option is the payoff. Risk-less hedge. Whatever be the outcome, it is risk-less. Remember, and because binomial assumes that risk-neutral or a risk-less setup, the relevant discount rate for the binomial setup will always be the risk-free rate. ये आपको शायद कभी strike हुआ नहीं, आपने सोचा नहीं, but आपको वहां पे दिमाग लगाना चाहिए था. That sir, we are trying to value an equity share. Equity share cannot be discounted as risk. All sums that you did in binomial, in derivatives, in every sum question give you risk-free rate. आइडियल हमारे दिमाग में बत्ती जलना चाहिए कि सर ये तो हम equity valuation कर रहे हैं. At the end of the day, options are based on equity shares. Equity shares are not risk-free. And as a result, how can this option valuation consider only the risk-free rate as discount rate? It should consider KE ना, but कोई भी सम में KE नहीं था. वो तो अब तक अपने को स्ट्राइक नहीं होता. यहाँ पे 2 रेट दिया है. Otherwise, there was no sum with KE. Why was there no sum with KE? Because the positions that were being built were risk-less positions, risk-neutral positions, where we were saying that, well, you know what, this is the position today. What if, even if there are risky assets, I've built up a portfolio which is perfectly hedged. Remember that position that N1 is equal to N2? And because N1 is equal to N2, it is a hedged position, and hedged position is not a risky position, it is a risk-free position. And hence the relevant discount rate for the binomial option valuation is the risk-free rate. Not just in this case, even in the case of other questions. Are we clear with this? So over here, R यहाँ पे आप क्या लोगे? 8%. Again, you will sit to find the probability. So how will you find the probability? We'll say, sir, 210 today is equal to 350 into P plus 120 into 1 minus P divided by क्या? 1 plus 0.08. You have to find the risk neutral probabilities, not based on a risky position. And hence, this is 210 into 1.08 equals, sorry. This is 250 that you'll have to invest today, my bad. you'll have to invest 250 today. And if you invest 250 today, that is the value of the asset today, I'm sorry, you will get 210 in today's terms. So your NPV today is negative. But if you want 350, after 1 year, or if you want 120 after 1 year, today you have to invest 250 rupees. See, if the value is 210, that is the present value of future cash flows, that is the theoretical value. So if I look at only today's value, it is not worth investing. But I am saying कि चलो आज worth नहीं है, but आज से 1 साल बाद the value might go up. Today's, if I look at today's position, the share can give me only 21 का dividend. But I am saying 1 year later, the price may jump up to 350, or 1 year later, the price may go down to 120. But if I want the 350, I will have to invest 250 today. अरे yes or no? If I want 350, मेरे को 210 invest करके तो नहीं मिलेगा. The actual asset today, you will have to construct a solar plant which will cost you 250 rupees. Are we clear with this? So over here, this will be, let us say, 250 into 1.08 equals 350p plus 120 minus 120p. Therefore, 250 into 1.08 comes to 270. That is 350 minus 120. कितना आता है? 230p plus 120. You can take 120 on the other side. So this is what? 150 equals 230p. Therefore, p equals what? 150 by 230 comes to 0.652. Achha, if p is 0.652, 1 minus p is how much? 348. Now what? We have to decide कि भाई ठीक है, the decision that I want to invest today, is not worth. Investing today is definitely not worth, but is it worth investing for a possible upside in the future? Well, I will say that if I invest 250 today, I am possibly sitting on a project which has an NPV of 100 rupees after 1 year. अच्छा, but 100 का possibility क्या है? 0.6528. Or a project, see, I have invested 250. It is not an option कि भाई ठीक है तो abandon कर देंगे. No, I've invested 250. And then if the price becomes 12 rupees, I'm stuck with a project which burns 130. And इसका probability क्या है? 0.348. But all of this is going to happen after 1 year once a government change happens. And as a result, you divide this by 1.08. So this is what? 100 into 0.6528 m plus negative 130 into 0.348 m minus MRC. This is 20.04 upon 1.08. This comes to what? 18.5 approximately. Now what does this indicate? This is an average NPV which is, let us say, positive. What does this indicate? Well, this kind of indicates that it is not advisable to buy the project based on today's situation. However, 1 year later, the project has a possible upside or a possible downside. And as a result, considering that, your average NPV over here can come down. See, यहाँ पे आपने भले 130 negative लिया, you have taken 100 positive, but the possibility of this happening is significantly higher, 0.6528 as compared to this happening. And as a result, over here, if you go to see, these are called as timing options. So as a reference note over here, if you see, the evaluation is done in a manner similar to binomial. Since there are two possibilities, it is like saying that on an investment of a share worth 250 today, the share may possibly give you 350 or 120 after 1 year. Reference binomial evaluation is done based on a risk-less or risk-neutral setup, and hence the relevant discount rate for the binomial will be the risk-free rate. So you find this expected NPV as 18.48. Since the expected NPV is positive, it is advisable for us to wait for 1 year. It is something where the true value of the project will be known only after 1 year. Reference note: in this question, there are no separate options given by any party. However, the decision to be made is whether it is worth waiting for a year or not. Hence, if the cash flows are 12 lakhs, NPV would be negative. We should not write 0. since there are no options. Further, the project starts after 1 year and hence the relevant discount rate to compensate the time value will be 8%. Okay, this is question 49. Have a broad understanding and proceed. And the last question over here is question 47. Now in question 47, in real options, they have used Black and Scholes. In Black and Scholes, वो तो अपने को वैसे भी नहीं आता था. Now there is one more challenge that they've added. So over here, when you look at Black and Scholes model, over here, what was the formula if you remember? Your C0 would be S0 into ND1 minus XP upon E raised to RT into ND2, where your S0 was the spot price, but in capital budgeting projects, there would be no spot price. So maybe the present value of benefits that you are expecting, maybe this can be the S0. This can be the PV of benefits that you are expecting. That is what the institute has done. They have not given you any explanation on either of them. It is just directly 3 sums given. So for the timing, kuch aayega to yehi lines pe aayega. So we'll have to remember this, unfortunately. So this is present value of benefits. What is your exercise price? Well, your exercise price is similar to the cost of development. So if you are incurring certain cost to develop something on account of which you are getting a benefit, the cost of development is treated similar to exercise price. Then there is a new term which is added over here, that is upon E raised to dt. Usually that S0 के साथ E raised to dt नहीं आता था. Now what is D over here? D is treated similar to delay. Delay is like the dividend. So they treat it similar. Why I don't know the reason, honestly. I've tried to think a lot, but मेरे को नहीं समझ में आ रहा. So over here, they treat it as delay, which is calculated as 1 by n. So n is the number of years in the project. So n is the number of years, and based on that, you will try to find something like this. Are we clear with this? We'll review this once. नहीं, एक सेकंड ओपन करते हो, ये नंबर्स के साथ देखते हो, उसके बाद आप लिखो. There is also one more change that will happen in the D1 calculation, and that's it. If you remember the formula, apply it and you will get your marks. So question 47. ABC Limited is a pharmaceutical company possessing a patent of a drug called Addn, a medicine for AIDS patients. Being an approach drug, ABC holds the right of production of drugs and its marketing. Okay. The period of patent is 15 years. This is your time, I think. T या फिर N, whatever that is. 15 years. After which any other pharmaceutical company can produce the drugs with the same formula. It is estimated that the company shall require to incur 12.5 million of development cost and market of the drug. I will have to require, this is treated similar to XP. So the cost to develop. As per a survey conducted, the expected present value of cash flows from the sale of the drug for a period of 15 years will be 16.7. What will you treat this 16.7 as? S0. This is treated in a manner similar to S0. Cash flow from previous types of drugs have exhibited a variance of 26.8%. Acha, what is this? Standard deviation. Remember, for you to apply Black and Scholes, you need this data. Otherwise, everywhere you applied binomial. Why? Because up move, down move was given. But the moment volatility, deviation is given, you'll have to apply Black and Scholes method. Are we clear with this? Yes? Okay. So over here, cash flow from similar types of drugs have exhibited 28.6% variation. The current yield on the treasury bonds of similar duration is 7.8%. This is R. Determine the value of the patent given that the natural log of a particular number is 0.2897 and e raised to 1.0005 and e raised to 1.17 is given to you. We'll see how this is to be used. Okay, so over here, what is the formula? Well, S0, the new term over here is upon e raised to dr, where d is the delay and r is the rate of interest. And यहाँ पे क्या आता था? RT आता था. So this is the same. So basically S0 into e raised to minus dr, that's fine, you divide it, minus x into e raised to minus RT. So institute के material में you have seen these numbers minus minus. So students are always क्या sir minus क्या? Well, that is nothing but divided by. So basically e raised to, if you have e raised to RT, 1 upon e raised to RT is nothing but e raised to minus RT. So that's one and the same. So you don't get confused by that minus sign. That's okay. So what is S0? This is PV of benefits. What is XP? That is cost of development. So ICAI has interpreted 12.5 to be the payment to acquire the patent rights. That is like a payment to acquire share. And 16.7 is interpreted to be the spot price, which is like the present value future cash flows. अभी ऐसा क्यों है? We don't know, but this is real options. So this is what the institute has interpreted. If it comes, we do it that way. And D refers to, this is a new thing. This refers to the cost of delay, that is 1 by n, that is 1 by 15. That's 0.0067. Delay factor is similar to dividend. ICAI interprets the delay rate to be similar to the dividend rate. Delay would reduce the cash inflows, which is similar to cash outflows, which arise on account of dividend. So when you look at the dividend, the spot holder does not get that dividend. Delay would kind of reduce, is what probably the institute is interpreting, but this is my best guess. They have not really explained what is happening, why is it happening. So over here, this is e raised to, let's say dr. And if we do these workings, what are the 5 steps? So this is, what are your 5 steps? The first step is what? The natural log of S0 by XP. Acha, what is the natural log of S0? S0 is 16 point and XP is 12.5. So if you take the natural log 16.7 upon 12.5, this comes to what? Natural log of 1.336. This comes to what? Is it given? 0.2897. So this is 0.2897. This is the natural log value. अच्छा, next you calculate D1. कुछ पूछ के फायदा नहीं है. You remember the formula? So over here natural log of S0 by XP plus. अच्छा, usually we had R. Now you have R minus D. The delay would be subtracted. This is a second change upon variance divided by 2 into T. This was a D1 formula upon standard deviation into the root of T. Are we getting this? So this was your D1 formula where you took 0.2897 plus, acha, what is your R? 0.078. R is 0.078. Minus D. What is D? So D over here is 1 divided by 15. 1 by 15 is 0.0667. So this is minus 0.0667. This is minus plus variance. Achha, is that standard deviation or is that variance? So is it already squared? Do I need to square it again? No. Divided by 2 into T. अच्छा, T यहाँ पे क्या है? 15 years upon standard deviation. अच्छा, now do I need to square root 0.268? Yes, into T. What is T? Root of T. This is root of 15. Remember, what is given as 26.8 is variance. Variance is standard deviation squared. You have to square root it to find the standard deviation. So over here, this is what? 0.2897 plus, achha, this is what? 0.078 minus 0.0667 plus, this is 0.268 divided by 2. So if I total it, 0.1453 into 15, this is what? 2.17 95 upon 0.268 square rooted. This is 0.5177 into 15 square rooted, 3.87. So this is what? 0.2897 plus 2.1795. This is 2.4692 upon, if you take 0.517, sorry, 2.0, approximately 2. 2.4692 upon 2. This is 1.23. So this is your D1 value. If I go to see ये पूरा working करने के बाद, you can find the D1 value, that is approximately 1.23, and D2 is usually calculated as D1 minus the denominator. So this is root of t into standard deviation, which is 1.23 minus what was there in the denominator, I think 2, ultimately 2 tha, which means this comes to a negative 1.23 minus 2, this is negative 0.77 approximately, या फिर 0.78, that's fine. This is a negative value. Are we clear with this? Acha, next we had to find what? We had to find ND1, and ND1 is from the left tail all the way up to D1 and left tail up to D2. So here, what is your D1? 1.23. Does it plot on the right side of the center or left side? Right side. So it will plot on the right side. So if we look at the normal distribution table over here, this will be giving you the area from the center. So if I look at the normal distribution table over here, I want 1.23, right? So this is 1.23. So number is 0.3907. So this will be my area, which will be 1.23. यहाँ पे plot हो रहा है. So this entire shaded area will be 0.3907. But I have to find the area from the left tail. So this is 0.5. If I add both of them, this is 0.8907. Does this make sense? 0.8907. अरे बराबर क्या नहीं? Similarly, you want, this is ND1. Now comes ND2. अच्छा, D2 is negative or positive? So it is plotted on the left hand side. अच्छा, this is 0.77 या 78. इन्होंने 78 लिया, so we'll just take that for ease of reference. So if you take 0.78, I just need the area from the left side. But if I look at the chart, 0.78 will fall somewhere over here. 0.2823. Acha, this 0.2823 is the area over here. This is 0.2823. Acha, so what will be ND2? 0.5 minus 0.2823. So this is 0.5 minus 0.2823 comes to what? 0.2177. This comes to 0.2177. This is the area of the left tail. And now what you have to find? Well, you have to find e raised to RT. And then e raised to RD. दो चीज find करना. अच्छा, e raised to RT, if you do e raised to R, which is 0.078 into n. This is how many years? 15 years. So this is 0.078 into 15 comes to what? 1.17. This is 1.17. Is this value given to us directly? Acha, secondly, e raised to RD, if you do, this is e raised to 0.078 into D. D is 0.0667. If I multiply this 0.078 into 0.0667, this is e raised to 0.0, एक सेकंड, 1/15 अगर अपन करें, yes, 0.078 into 0.0667, that's right, e raised to 0.005. Achha, let us see the question. What are the values given? अच्छा, फर्स्ट यू हैव बीन गिवन ई रेस टू कितना है 0005, अपने को कितना आ रहा है, एक सेकंड ना, I think there's a printing mistake there. एक second ना. So if I do point, एक second ना, 0.067 into, अच्छा I think मैंने एक फॉर्मूला यहाँ पे कुछ गड़बड़ की है. So this is dt actually. एक second ना. This is dt. This is also dt. So basically if यहाँ पे भी अगर आपने लिखा रहेगा this is dt. So if you take this into 15.0667 into 15, that's 1.0005. So this is e raised to 0.05. This is given to you how much? 0.3677 and e raised to 1.17. Just a second, यहाँ पे भी minus नहीं होना चाहिए. It's a direct number only if I'm not wrong. This is e raised to 1.17
because it's in the denominator, it's minus.
So basically चलो अपन for the timing we'll take this same value 0.31.
So it has to be minus only because it's in the denominator in the formula.
हाँ तो so basically e raised to, so if we have to take in the denominator, this is 1 divided by e raised to 1.17. This will be e raised to minus 1.17.
Both have to be minus.
So this is 0.3104. So if
That has to be minus.
एक सेकंड इसका एप्लीकेशन देख लेते ना इधर. This is 0.36, 0.31. Yes.
Both are minus.
Yes. So even this has to be a negative number ultimately. 1 raised to. So over here, if I just apply these numbers now, so when I look at the spot price is what? 16.7 upon, so you have e raised to RT. If you were to multiply this, this is 0.3677 into ND1 was 0.8907 minus 12.5. This 12.5 भी आपको मल्टीप्लाई अगर करना है 0.3104 and into what? 0.2177. Now just remember the way this is and solve rather than going too much into the detailing. 16.7 into 0.3677 into 0.8907 469 minus 12.5 into 0.3109 into 0.2177, which will come to 4.62. Just in case this lands up, there's no very detailed logical base over here. So if this comes, you just follow the same pattern and that's it. So that will take care of these 3 questions for derivatives as well. If you go to your shield, around at the end, when you look at derivatives, at the end on derivatives after option Greeks, there are some new theory parts and there is something regarding real options. So over here, I think आपके बुक में कौन सा है, पेज 113 या कुछ होगा, 111, 12, वो behind, just a second, so उसके भी पीछे जाए. Yes. So these are new theory parts. You see weather derivatives, credit default swaps. There are no sums on this. It is pure theory. It is just newly added. So we have put it over there. आगे जाइए. This is page 112 only. Okay. So if you go to page 111 or 112, so at the end you have real options. Now what do you mean by real options? This is an approach to capital budgeting that relies on option pricing theory to evaluate projects. So we have used these real options in the last 2-3 problems. Insights from option analytics can improve the estimates of project value, like if there are abandonment options, etc., that can improve the value. Real options is intended to supplement and not replace the capital budgeting analysis. So real options versus financial options, well, real options have underlying as the projects. Payoff is estimated from project cash flows and hence can be varied. Exercise period is fairly long in case of real options. So this is just theory in case it comes up. So there are various real options that you might have. Long call, that is a right to enter into the project at a later date, whereas long put is a right to exit the project at a later date. So as a project holder, these are the rights that you will value. The right to enter into a project at a later date, or the right to exit from a project at a later date. Like in that solar power plant, if I have a right to enter into a project after 1 year, then I can wait for 1 year, see the government regulations and enter into the project then. Or if I have a right to exit the project, then if I get 30% or 40% less, I can exit the project and get 80 rupees. Short call, short put is where you are giving that option to the other party. You are giving the option that if they want to take the project from you, they can take. Or the other way around. So these are real options like long or short, call or put. Valuation of real options will be done in the same way using binomial or Black-Scholes. However, sometimes it is difficult to value certain inputs, as we saw. There can be growth options, there can be abandonment options, there can be timing options. So over here, abandonment options are like long put options. So once the funds have been committed, they cannot be reverted without heavy losses. In some cases, firm may like to opt for abandoning without incurring those losses. So this is like an American put option where you can abandon the project for the project's assets. Timing options, again, they can either be accepted or rejected, implying that we are saying that it is you can accept or reject, but however you might want to wait for some time before you decide. So these are timing options. That is, what if you delay the decision, then what is the gain? Like an American call. So this is like a long call option. And there is growth options where sometimes it is possible some projects may have a negative or insignificant NPV, but in the future it might result in a higher NPV. Like you have done heavy R&D, so you believe uska zyada fayda later hoega, or big advertisement, in which case it is heavy cost today, but it will result in a higher cash flow in the future, and so on. So these are just theory points you can refer. Institute has added a bit of theory. Theory you can refer through a separate section. I'll share a separate class after this for theory. It is also there on YouTube. There are 2 separate full videos for theory. There are certain chapters like securitization, startup finance, etc., which are pure theory chapters. Earlier that there was close to a 15-20 mark weightage on that. There are 2 videos on YouTube, and in any case I'll share a separate video separately as well. You can refer that. Maybe at a later point. As of now, you need to get hold of the practical part. Once you are comfortable with the practical part, you can refer the theory, because it's a very wide section. Kuch bhi aa sakta hai, so we have a general understanding and we proceed, right? So this is new theory which is added. Let us in the derivatives chapter. We have even shared that separately, but nevertheless, there are a few option terminologies. Like there is exotic options. There are a few exotic option types which are given, like a chooser option. Like a chooser option is an option where at the exercise date you can choose whether this is a call or a put option. Ideally तो हमको पहले ही decide करना पड़ता है call or put. In a chooser option, at the end you can choose whether you want to treat this like a call or you want to treat it like a put. So this is very beneficial for the holder. इसका premium बहुत high होता है, right? Compound options. Over here, these are options which give you an option to buy, in the sense that this is an option on option. So an option is given where after a future date you can decide to buy, or you can decide a particular exercise price. A barrier options are options which will be activated, not necessarily exercise, only for particular barrier is breached. Otherwise, they will not be activated only. So if you will say कि by exercise price होने दो 150, but you will not even touch this option if the price during the period does not cross a particular level. Binary options, that is digital options. तो यहाँ पे usually payoff you have to calculate spot at expiry minus exercise price. यहाँ पे ऐसा नहीं होगा. Payoff will be defined. If a particular event happens, you get this amount. If it does not happen, you get nothing. ऐसा नहीं कि भाई spot price minus exercise price. It is binary, one of the two. You either get zero or you get a specified amount, not spot minus exercise price. Asian options. अपन पीछे रह गए. आपने बोला there is European option, there is American option, तो हमारा भी option होना चाहिए. So there is an Asian option where you don't take the spot at expiry or spot today. You take the average spot price. So if it's a 3-month, you will take the average price during the period and compare it with the exercise price. In American option, you take today's price. In European option, you wait till expiry, take the exercise price at spot at expiry. In the Asian options, you will take the average price. Bermuda options, ये सब आप रीड करें, आगे बढ़े, कुछ आ जाता तो ठीक है. I don't see some. It's an option which is restricted where exercise can happen on certain dates. Basket options does not have a single product. It has a basket of assets as underlying, has a portfolio as underlying. Spread options, you are looking at the spread, not the price, the difference. Let's say you are looking at option considering the spread against the Nifty. So these are spread. Look back options, in which case exercise price, you can look back and decide based on whatever has happened in the past, which is the most favorable exercise price, and you can decide whatever exercise price based on that price range. तो आप एक बार रिव्यू कर ले, अगर कुछ आ जाता तो it's pure theory. Credit derivatives, there can be types of credit derivatives like collateralized debt obligation. This is done when you do securitization. What happens in case of a collateralized debt obligation? You might be a company who might want to securitize. Securitize means you have a bundle of loans, but these loans are illiquid. You kind of pack them into a group and sell it to someone, and you pass on the cash flows. So over here, the other party will give you the cash. Today, you can use that to buy the loan. And loan say whatever cash flows are coming will directly be passed on. So these are collateralized obligations, mostly done in securitization setup. A lot of complex things are there. इतना detail में देखने का जरूरत नहीं है. It's fine. Then you have credit default swaps. Just a second, CDS. Just for your knowledge, what is a credit default swap? Well, as a holder, I am worried that what if this bond defaults? What if the bond what if the company whose bond I am holding, that company defaults? What will I do? So I'm worried about that. So in that particular situation, there may be people who are saying that, well, if they default, we will pay for that. It's like an insurance contract for which we'll have to pay a premium. So if the probability of default increases, the CDS premium increases. If the company is at a very good credit standing, people are not going to pay enough premium because they think that the default is not going to happen. So this is like a credit default swap. Again, you can review this once. Broad theory here, iske upar there's no sum, no illustration, nothing. So this is in case a default takes place, then we will settle. In case there is no default, there is no cash flow. Although it resembles options, it more resembles like a swap. The amount of premium depends on the price of underlying, especially when the credit risk is more. And there is some theory. ये हमने पूरा डाल दिया. I have not put selective theory. I have just put whatever is relevant. You can just refer that. इसके ऊपर sums तो नहीं आएगा. It will be more of a theory part only. Weather derivatives. What do you mean by weather derivative? It is like rainfall, temperature. इसके ऊपर भी derivative लग सकता है. This is largely linked to volume. Like, see, we will say, why do you need a weather derivative? If I am someone like a farmer, I am worried that if the weather goes adverse, like there was a cyclone recently in the south of India. अभी that cyclone के वजह से if I suffer a loss, ना, that will be covered by an insurance contract. However, if in a particular year there is less rainfall and I have lesser volume of my crops, वो insurance company compensate नहीं करता for lesser rainfall. Insurance company only compensates you for the risk arising from extreme weather events like a tsunami, like a cyclone, etc. If in a particular year weather is normal, maybe there is some more or some less rainfall because of which your crops are not growing as much. that loss is not covered by the insurance company. How do you hedge that? By using weather derivatives. Weather derivatives will be derivatives where you look at certain factors of weather, and based on that you have the volume of output as the base. Are we clear with this? Broad understanding? So over here they are mainly companies and farmers whose performance is adversely affected due to weather. Now it is very difficult to price a weather derivative because it's very difficult to get adequate data or try to find the temperature and the direct impact on volume. It's fairly difficult to do that. And then you have electricity derivatives. Now this is easy. Electricity derivative looks at power as the base. So it can be a forward, it can be a future, it can be an option, anything but considering power. So right to buy power, right to sell power, etc. So these are electricity derivatives. Again, there is forward, future, swaps, etc. Usually this is to have an assured power at an assured rate. Barabar? So just refer this theory, not very important from an exam perspective, just in, numerical perspective it will not come, but if it comes in theory at the end you should refer. So this kind of takes care of almost your entire numerical section of your AFM.